Welcome to Wealth Wise Mindset. I'm Sean, and here we break down personal finance and investing so you can build real wealth wisely without the noise. Now, let me ask you this. Have you ever thought about investing in the stock market but felt completely lost on where to start? Maybe it sounds intimidating or risky or just plain confusing. If that's you, you're not alone. And the good news is, you don't need to be a financial expert to get started. In this video, we're breaking down the stock market for beginners, what it is, how it works, and how you can start investing with confidence, even if you're starting from zero. Let's dive in. What is the stock market? Let's start with the basics. What is the stock market? The stock market is simply a marketplace where investors buy and sell pieces of companies, called stocks or shares. When you buy a stock, you're literally buying a small piece of ownership in a company like Apple, Amazon, or Coca-Cola. If the company grows and becomes more valuable over time, your shares usually become more valuable too. So think of the stock market not like a casino, but more like a collection of real businesses you can invest in. The most well-known US stock markets are the New York Stock Exchange, NYSE, and the NASDAQ. These markets are where thousands of companies are traded every day and where you can invest your money to grow over time. Why you should invest in stocks. So, why should you care about the stock market? One word, growth. Historically, the stock market has returned about 7% to 10% per year on average after inflation. That's far more than what you'd earn in a typical savings account. If your goal is to build wealth, beat inflation, or retire comfortably, the stock market is one of the most powerful tools available. Let's say you invest $100 a month in an index fund that returns 8% annually. In 30 years, you'd have over $135,000 from just 36,000 of your own money. That's the power of compound growth. And here's the best part. You don't need to pick individual stocks or time the market to benefit. We'll talk about that in a bit. Myths and misconceptions. Now, before we go further, let's clear up a few common myths that stop people from getting started. Investing is only for rich people. Not true. You can start with as little as $5 or $10 thanks to fractional shares. Number two, it's too risky. I could lose everything. Yes, prices go up and down, but if you invest wisely and go for the long term, the risk of losing everything is extremely low. Diversification helps manage that. Number three, I have to pick the right stocks. Nope, you don't need to be a stock picking genius. In fact, many beginners do better by not picking individual stocks at all. More on that next. How to start investing. All right, so how do you actually get started? Here's a simple 5-step roadmap. Step 1, build your financial foundation. Before you invest, make sure you have an emergency fund, 3 to 6 months of expenses, are not drowning in high interest debt like credit cards. This gives you stability so you won't need to pull out your investments when life happens. Step 2, choose an investing account. To buy stocks, you need a brokerage account. Some beginner-friendly options include Fidelity, Charles Schwab, Vanguard, Robinhood, Public, SoFi Invest. Make sure the account is free to open, has zero trading fees, and allows you to buy fractional shares. If you're investing for retirement, consider tax-advantaged accounts like Roth IRA or 401k first. Step 3, pick your investment strategy. If you're a beginner, keep it simple. Here are two smart starting points. Index funds. These are bundles of stocks that track the overall market, like the S&P 500. They're low cost, diversified, and easy to understand. ETFs, exchange traded funds, similar to index funds, but trade like individual stocks. A great example, VTI, Total US Market, or VOO, S&P 500. You don't need to pick the next Tesla or time the market. Just buy broad market funds and let time do the work. Step 4, start small and be consistent. You don't need thousands to begin. Start with what you can even $50 or $100 a month. Set up automatic monthly contributions if you can. This is called dollar cost averaging, and it removes emotion from the process. Step 5, think long term. This is not a get rich quick game. Stocks go up and down in the short term, but over decades the trend is upward. Your goal is to stay in the market, not time it. Let me give you a real world example. Let's say Maya is 25 years old. She has an emergency fund, no credit card debt, and $100 a month to invest. She opens a Roth IRA with Fidelity. Inside that account, she buys $100 of FXAIX, an S&P 500 index fund, every month automatically. She doesn't pick individual stocks. She doesn't try to time the market. She just sets it and forgets it. Fast forward 30 years. She's invested $36,000 of her own money, and thanks to compounding, that could be worth over $130,000 to $200,000 depending on the market's return. Maya didn't need to be a stock expert, just consistent. Mistakes to avoid. As a beginner, here are a few common mistakes to avoid. Number one, investing before you're ready. Don't skip the emergency fund or ignore debt. Number two, putting all your money in one stock. Diversification is key. Don't bet everything on one company, no matter how hyped it is. Number three, checking your account every day. This creates unnecessary stress. Think in years, not days. Number four, trying to time the market. Even pros can't do this consistently. Focus on time in the market, not timing the market. So to wrap it up, the stock market is just a place to buy pieces of real businesses. It's one of the best ways to grow your money over time. You don't need to be rich or smart. You just need to start. Stay consistent and think long term. If you're feeling overwhelmed, just remember, you don't need to know everything to begin. You just need to take the first step. So, what's your next move? Are you opening your first account? Still building your emergency fund? Drop a comment below. I'd love to hear where you are at. And if this helped you feel a little more confident about investing, give this video a thumbs up and subscribe to Wealthwise Mindset for more no fluff personal finance and investing tips every week. Stay patient, stay consistent, and as always, build your wealth wisely.